Welcome back to the deep end. Today, we are wading into waters that I think terrify about, I don't know, 90% of the population.
Totally.
It's that moment where you finally decide, okay, I'm going to get my financial act together. You've got some savings, you open an app, you click invest, and then
Nothing.
complete and utter brain freeze.
It's the cereal aisle problem, but with your life savings. You're just staring at this wall of options.
Yeah.
Thousands of schemes, all with these confusing names, acronyms that look like Wi-Fi passwords.
Right.
And you just have no idea if you're picking the healthy whole grain option or the one that's basically just sugar and fancy marketing.
Exactly. And the stakes are, let's be honest, a lot higher than a bad breakfast. We are talking about retirement funds, a down payment on a house, maybe your kid's education. So what usually happens is people just freeze. Or, even worse, they just pick the fund that has the biggest, greenest percentage number next to it from last year.
Which, as we're about to discover, is functionally equivalent to driving a car while staring exclusively into the rearview mirror.
That's a great way to put it.
It works great for a while until the road takes a sharp turn.
So to stop all of us from crashing and burning, we are doing a deep dive today into a very specific, very rigorous text. We are analyzing the NISM Series V-A Mutual Fund Distributors Certification Examination Workbook.
Whew, that's a mouthful.
It is, but this is the important part. We're looking at Chapter 12, Scheme Selection.
And this is the manual. This is literally what the professionals, the distributors, the advisors, they have to study this to get certified to sell you these products.
So we're getting the inside scoop.
We are bypassing the glossy sales brochure and going straight to the architectural blueprints of how a proper portfolio should be constructed.
Our mission today is, I think, pretty ambitious. We want to take you, the listener, from that state of choice overload to being able to look at a fund fact sheet and actually know what you're looking at.
To be able to decode it.
Yes. And we're going to break this down into 3 parts. I like this structure: the investor, the menu, and the chef.
I like that because you really can't pick a chef until you know what you want to eat.
Exactly. You can't just walk into a restaurant and say, give me food.
You'll get something, but it probably won't be what you need.
So let's start with the investor. The workbook makes a really, really strong point right out of the gate. Selection does not start with the product. It starts with the need.
Right.
Now, need feels a bit abstract. I mean, doesn't everyone need to make money?
Sure, on the surface, everyone wants more. But in finance, a need is really defined by your constraints, specifically your time horizon and your need for liquidity.
Okay.
The text uses a great framework here. You have to ask yourself one question. Are you parking? Are you growing? Or are you harvesting?
Break those down for us. Parking sounds temporary. It implies the car is just stopped for a bit.
Exactly. Imagine a listener who just sold their apartment. They have a big lump sum, say 50 lakh, just sitting in their bank account.
Okay, a nice problem to have.
A very nice problem, but it's a problem. They need that money in, say, 3 months to make the down payment on a new place they're buying.
Okay, so that money has a very specific job to do on a very specific timeline, exactly 90 days.
Correct. So that investor's primary overwhelming need is capital protection and liquidity. They absolutely cannot afford for the market to drop 10% because of some bad news cycle.
Because if that 50 lakh becomes 45...
they might lose the new house. So for them, looking at an equity fund, even a fantastic 5-star equity fund, would be disastrously wrong.
They need to park. They need something safe and accessible.
Yes. Versus, say, someone who is 30 years old and is just starting to save for retirement.
A completely different animal.
Totally different. That person is growing. They have a 25, maybe 30-year horizon. If the market crashes next week, it's almost irrelevant to them.
You could even argue it's a good thing for them.
It might be. It's a sale. They can buy more units more cheaply with their next paycheck. For them, the real risk isn't market volatility. The real risk is inflation.
The risk that their money is worth less in 30 years.
Exactly. They need to beat the rising cost of living over decades. Their money has to grow, not just sit there.
And the third one, harvesting.
That's the retiree. They've already built the pile of money. They've done the growing part. But now they need to turn that pile into a monthly paycheck to buy groceries and pay bills.
They need regular cash flow.
They need predictable income. So you see, before you even look at a fund's name or its one-year return, you have to diagnose yourself. Are you a parker, a grower, or a harvester?
If you buy a growth product when you have a parking need, you're not investing.
You're gambling. Pure and simple.
Okay, this This leads us directly to what the workbook says is the single most important concept in the entire chapter, and maybe in investing, period: asset allocation. The workbook claims this is more important than picking the right stock, more important than finding the next star fund manager. That sounds crazy.
It does sound counterintuitive, but the data is overwhelming. It's based on something called the Brinson study, though the workbook simplifies it. Essentially, various studies have suggested that over 90% of the variability in your portfolio's return.
90%?
Over 90% is determined by your asset allocation, not by picking the best stock or the best fund.
That is just wild. We spend hours, days, obsessing over whether to buy Fund A or Fund B from the same category.
Right.
But you're saying the much bigger decision, the one that actually moves the needle, is deciding to be 60% in equities versus, say, 80% in equities.
That's it. Think of it like cooking a meal. Asset allocation is deciding the ratio of protein, carbs, and vegetables on your plate.
Okay, I like that.
Fund selection is just deciding whether the protein is going to be chicken or fish.
Mm-hmm.
If you decide your diet is going to be 100% carbs, let's say 100% debt funds, it doesn't matter if you pick the single best debt fund in the history of the world.
You're still just eating bread.
You're just eating bread. You will never, ever get the returns of a balanced diet.
Yeah.
You are fundamentally capped by the potential of that asset class.
So step one, before anything else, is to figure out your personal pie chart.
Mm-hmm.
How much equity, how much debt, maybe some gold or other things.
Your strategic allocation, yes.
Once we have that pie chart, do we just go out and buy one big fund for each slice? Like one equity fund, one debt fund, and we're done?
You could. That's a perfectly valid, simple strategy.
Oh.
But the source material suggests a slightly more sophisticated approach, a strategy called core and satellite.
This sounds like NASA terminology now.
A little bit, but the concept is very grounded. It's about separating stability from tactical opportunity.
Okay.
The core is your foundation. Think of it as the sun in your financial solar system.
Oh,
This is the big, boring, stable stuff.
the meat and potatoes of the portfolio.
Exactly. For an equity investor, your core would typically be a large cap fund or a broad diversified equity fund. It's meant to track the overall economy.
You're not trying to be a hero with this part.
No. You buy the core to participate in the long-term, slow and steady growth of the economy. You hold it for years. You don't trade it. You don't touch it. Its job is just to capture the market return, or beta.
Okay, that makes sense. So what's the satellite?
The satellite is where you get to be a bit more adventurous. It's where you scratch that itch for higher returns or to play a specific hunch. This is the tactical part of your portfolio.
So this is a smaller slice of the pie.
Much smaller. Maybe 10, 15, 20% of your total portfolio max. This is where you might bet on a specific theme or sector you believe in.
Give me a concrete example.
Let's say you've been reading the news and you're absolutely convinced that the electric vehicle and green energy sector is going to boom over the next 2 years because of new government policies.
Right, a specific theme.
You wouldn't want to bet your entire life savings on that, right? Because if you're wrong, or if it takes 10 years to play out instead of 2, you're in serious trouble.
My retirement is ruined.
But you could take 10% of your portfolio and buy an infrastructure or a thematic ESG fund as a satellite holding.
So if the EV theme really takes off, I get that extra juice in my portfolio, that alpha.
You get the alpha, you outperform. But if it crashes and burns,
My core portfolio keeps me alive.
your core keeps you on track for your long-term goals. You don't lose your retirement. The satellite allows you to take focused, calculated risks without blowing up your entire financial life.
I really like that framing. It manages the FOMO, the fear of missing out. You see a trend, you want to get in on it, but this gives you a structured way to do it with a safety belt on.
Precisely. Now, speaking of safety belts, we have to talk about risk. The workbook is very, very specific here. Risk isn't a binary thing. It's not just safe or unsafe.
It's a spectrum.
It's a hierarchy, a ladder. And you absolutely need to know which rung of that ladder you are standing on before you invest.
Okay, so let's climb the ladder. What's on the bottom rung?
The very bottom, the most stable ground, you have liquid funds. These funds invest in super short-term securities that mature in days, sometimes hours.
So the risk of losing your principal is almost zero.
It's near zero, but of course, so is the return. You're barely going to beat a savings account. It's just a place to park cash for a few weeks.
Okay, step up a rung.
Step up a rung, and you're in the world of debt funds. Now you're lending money to companies or the government for months or even years. And you're taking on new kinds of risk.
Like what?
Primarily credit risk, which is the risk that the company you lent money to won't be able to pay you back.
They default.
And interest rate risk, the risk that changes in the economy's interest rates will make the price of your bonds fluctuate.
We'll definitely have to unpack that bond math later because that part is tricky for a lot of people.
It is.
What's the next rung up from debt?
That would be hybrid funds, a mix of debt and equity. And then at the very top of the ladder, you have equity funds. But, and this is the key, even within the world of equity, there is a sub-ladder of risk.
This is the part that I think confuses people. They just think stocks are stocks. They're all risky.
That is a huge, huge misconception. At the lower end of the equity risk ladder, you have large cap stocks. These are the top 100 biggest, most established companies in the country.
The giants. They're stable.
They're giants. They have massive cash reserves, diverse businesses. They aren't going bankrupt overnight. They're relatively stable.
Yeah.
But as you move down in size to mid-cap and then small-cap stocks,
That's the Wild West.
that's the Wild West. High risk, high potential reward. A small-cap company can easily double or triple in a year.
Then it can also go to zero.
It can also just disappear. So a small-cap fund is significantly riskier than a large-cap fund. And then at the very, very top of the risk ladder, the riskiest of all,
Let me guess. The sector fund.
the sector fund.
Because of that concentration problem we talked about.
Exactly. If you buy a broad, diversified fund and the entire auto sector has a terrible year and crashes,
The pharma stocks and the tech stocks and the banking stocks might save you.
they buffer the fall. But if you buy an auto sector fund and the auto sector crashes,
Damer.
you have nowhere to hide.
Now, to help people visualize all this, the regulator, SEBI, mandated something called the risk-o-meter. It sounds a bit like a carnival game, but the workbook stresses that it's actually a really important tool.
It is. And it's important to know that it's changed recently. It used to be just, 3 simple colors. Now it's 6 very distinct levels. And the workbook emphasizes that investors really need to know the specific colors and what they mean.
Okay, walk us through this rainbow of risk.
It starts at the bottom with low risk, which
Yeah.
is a color they specify as Irish green.
Irish green. Okay.
Then you move up to low to moderate risk, which is chartreuse.
Chartreuse, so that is incredibly specific.
Very specific. Then you have moderate risk, which is neon yellow. Next is moderately high, which is caramel.
Okay, so once we hit caramel, we're starting to get into the warning zone.
You're on alert. Above that is high, which is dark orange. And at the very top, very high risk is, unsurprisingly, red.
And where do most of the equity funds that we talk about, the diversified ones, the large caps, where do they usually fall?
Most of them are going to be in the top 2 categories. They'll be high, so dark orange, or very high, which is red.
Okay.
But here is the kicker. Here's the single most important thing this source highlights about the risk-o-meter. This isn't a sticker they just slap on the fund when it's launched and then forget about it.
It's not permanent.
It is dynamic. It can change.
So my fund could be, say, orange in January and then suddenly turn red in February. How?
Absolutely. The fund house is required by law to evaluate the portfolio's risk every single month. So if the fund manager suddenly sells all their safe, stable, large-cap stocks and buys a ton of volatile small caps,
The needle on the risk-o-meter moves.
that needle moves up. You, as an investor, need to be checking the fund's fact sheet regularly to see if the risk profile you signed up for is still the risk profile you have.
Wow, that's a big deal. Now, there's a little side note in the text about something called risk bands for SIFs. First, what is a SIF?
SIF stands for Strategic Investment Funds. You can think of these as things like hedge funds or alternative investment funds, generally for very high net worth individuals.
Okay, so not for your average investor.
Definitely not. They are far too complex for a simple risk-o-meter. So they use a different scale called risk bands, which goes from level 1 to 5. The simple takeaway is, if you ever see a document talking about risk bands, you are in the deep, deep end of the pool.
Proceed with extreme caution.
Yes.
Okay, this is great. So we've assessed our needs, Parker, grower, or harvester. We've built our core and satellite portfolio structure. We've checked the risk-o-meter to understand the hierarchy.
We've laid the foundation.
Now we actually have to order from the menu. We have to pick the strategies. And let's start with the biggest philosophical debate in the equity world, active versus passive.
This really is the great divide. Passive investing, which includes things like index funds or ETFs, is based on a very simple, and some would say cynical, idea
Which is?
that you can't beat the market.
Yeah.
So don't even try. Just buy the entire market, buy the Nifty 50 or the Sensex, and ride the wave.
And the big appeal there is that it's very low cost, right? Because you aren't paying some genius fund manager to sit in a room and pick stocks.
Exactly. You're paying a computer to just copy a list. So the fees are incredibly low, there's zero human bias, no manager risk, you're guaranteed to get the market's return, no more, but no less.
Okay, that's passive. So active is the opposite.
Active is the opposite.
Mhm.
You are hiring a fund manager and their team of analysts, and you are paying them a significantly higher fee to try and beat the index, to generate alpha.
But the data, especially from the US, often shows that most active managers don't beat the index over the long run.
That's the big catch. In highly efficient markets, like U.S. large-cap stocks, where information is everywhere and instantly priced in, it is incredibly hard for any one human to consistently know something that millions of other smart people don't.
So for that part of the market, passive seems like the smarter, cheaper choice.
For many people, yes. But where does active management still have an edge? In less efficient markets.
Like Indian small caps, for instance.
Exactly. The Indian small and mid-cap space is a perfect example. Information isn't as widespread. There are hundreds of companies that aren't well covered by analysts. A smart fund manager can actually go visit a factory in a small town, meet the management, and realize that a company is deeply undervalued.
They can find hidden gems.
They can find alpha before the rest of the world knows about it. That's where active management can really earn its keep.
So a potential strategy here could be to use passive funds for your large cap core portfolio, and then use active funds for your small or mid cap satellite portfolio where a manager has a real chance to add value.
That is a very robust, very professional grade way to construct a portfolio.
Okay, now let's talk about something more structural. The exit door. The difference between open-ended and close-ended funds. I used to think close-ended just meant it was like exclusive, a VIP club you couldn't get into.
I wish. It's actually more like a prison. Not really, but it is a lock-in.
Okay, explain.
An open-ended fund is what 99% of people know and should probably buy. You can buy new units today, you can sell them back to the fund tomorrow at the day's NAV. The fund company creates and destroys units on demand.
Liquidity is basically 100%.
Total liquidity. A closed-ended fund is different. You can only buy units during a short window when it's launched, the new fund offer or NFO.
And then what?
And then you are stuck. You're locked in for the duration of the fund, which is usually 3, 5, or even 10 years.
But wait, the workbook says you can sell them on the stock exchange just like a share?
That is the theory. And it's technically true. But in practice, the liquidity for these on the stock exchange is often a ghost town.
There are no buyers.
Very few buyers. And because there are no buyers, sellers who are desperate to get out often have to sell their units at a significant discount to their actual worth.
Okay, explain the discount. How does that work?
Let's say the fund owns a portfolio of shares that are actually worth, say, 20 rupees per unit. That's the net asset value, the NAV.
That's its true value.
That's its intrinsic value. If you try to sell that unit on the stock exchange, you might only find a buyer who's willing to pay you 17 or 18 rupees for it.
So I am voluntarily taking a 10 or 15% loss on my money just for the privilege of getting out early.
Exactly.
Yeah.
So the lesson is, unless you are absolutely 100% certain you will not need that money until the lock-in period ends, you should probably stay away from close-ended funds.
Good to know. Let's move to style. This is another one that trips people up. We have growth and value.
The tortoise and the hare.
Okay, so growth is the hare.
Yes. Growth investing is all about buying companies that are expanding fast. Their earnings are shooting up. They're in a hot industry. Everyone loves them. Think of, popular tech companies or exciting consumer brands.
And these are usually expensive stocks, right? They trade at high price-to-earnings ratios.
They do. They're expensive.
Yeah.
But you're buying them with the expectation that their growth is so strong that the price will just keep flying higher.
Yeah.
You're paying for future potential.
And value investing. The tortoise.
Value is the opposite. It's about rummaging in the bargain bin of the stock market. You're looking for solid, good companies that are just having a temporary bad time.
They're out of favor for some reason.
Maybe they had a product recall or a lawsuit or just a couple of bad quarters. The stock price is beaten down. It's cheap. You buy it, betting that the market has overreacted and that eventually its true worth will be recognized.
But there's a big, bold warning in the text about this, the value trap.
This is a crucial concept. Sometimes a stock is cheap because it should be cheap.
It's not a bargain, it's just a bad business.
It's a dying business. Its best days are behind it. If you buy that, you aren't getting a bargain. You're catching a falling knife. Distinguishing between temporary trouble and terminal decline is the core skill of a value investor.
And value requires a lot of patience, I'm guessing.
Extreme patience.
Huh.
You might be totally right that a stock is undervalued, but the market might take 3, 4, or 5 years to agree with you. If you need quick returns, value investing will absolutely drive you crazy.
Okay, now what about these newer categories that sound very similar? Multi-cap versus flexi-cap. They sound like synonyms to me.
They do, and for a long time, fund houses treated them that way. But the regulator, SEBI, stepped in a while ago to create a massive distinction between them, mainly because funds were, let's say, misbehaving.
How so?
A lot of funds call themselves multi-cap, implying they invested everywhere, but in reality, they were just hiding 80 or 90% of their money in large-cap stocks.
So they weren't truly diversified across market caps.
Not at all. So SEBI created a rule. A true multi-cap fund must, by law, invest a minimum of 25% of its money in large-cap stocks, a minimum of 25% in mid-cap stocks, and a minimum of 25% in small-cap stocks.
So it's a rigid, forced mandate.
Very rigid. The manager has no choice. Even if that manager is terrified and thinks small caps are about to crash, they still have to hold at least 25% in them. They are handcuffed to that diversification.
Okay, so then what is a flexi-cap fund?
FlexiCap is total freedom. The rule for them is simple. They must invest a minimum of 65% in equities, but beyond that, the manager can do whatever they want.
So they could be 100% in large caps today.
And then shift to be 50% mid-cap and 20% small-cap tomorrow.
Yeah.
If they think the market is changing, they can swing the bat however they see fit.
So a flexi-cap fund is really a bet on the fund manager's skill to time the market cycles and make the right calls.
Exactly.
Whereas a multi-cap fund is more of a bet on the structural allocation itself, that a mix of all three will do well over time, regardless of the manager's view.
That's the perfect way to frame it. If you want to fill it, shut it, forget it portfolio that guarantees you exposure to the whole market, multi-cap does that. Flexi-cap is for when you have immense faith in a particular manager to navigate the currents.
One last piece on the equity menu. International funds. Everyone seems to want a piece of the U.S. tech giants these days.
And it's a great tool for diversification, getting exposure to different economies, different companies. But you are consciously introducing a new and very important variable into your portfolio.
Which is?
Currency risk.
Right. How does that actually work?
You have to remember, you aren't just betting on the stock's performance. You're also implicitly betting on the exchange rate between, say, the Indian rupee and the U.S. dollar.
Okay.
Let's run a scenario. Let's say you invest in a U.S. fund, and the U.S. stock market stays completely flat for a year. Zero growth. But during that same year, the Indian rupee weakens by 5% against the U.S. dollar.
So my investment, when I convert it back to rupees, has actually gone up?
Yes. In rupee terms, your investment is now worth 5% more, even though the underlying stocks didn't move at all.
But the reverse is also true.
The reverse can be painful. If the U.S. market goes up 10%, but the rupee strengthens by 10% against the dollar, your net return in rupees is zero. The currency movement completely ate up your gains. You just have to be comfortable with that extra moving part.
Okay, let's switch gears to what many people think of as the safety net in the portfolio, debt funds. I feel like debt is actually harder for most people to understand because the math is less intuitive.
It absolutely is. With stocks, it's pretty simple. If a company does well, the stock price generally goes up. With bonds and debt funds, you have two different engines that are driving your returns. The workbook calls them the accrual strategy and the duration strategy.
Okay, let's separate those. Accrual is what I'd call the rent model.
Yes, that's a perfect analogy. This is the simple one to understand. The fund manager buys a bond from a company, which is like lending them money. The company agrees to pay a fixed interest rate every year. That's the rent.
And the fund manager just collects the rent.
They collect the interest and pass it on to you, the investor. The main risk here, as we mentioned, is credit risk.
Will the tenant pay the rent on time?
Exactly. Will the company be able to make its interest payments? And more importantly, will it be able to pay back the principal at the end? If the company goes bust, you can lose money.
And this is where funds with names like credit opportunities come in.
That sounds like a very nice, positive euphemism.
It is marketing speak for high yield, or, to be more blunt, junk bonds.
Okay.
These funds deliberately buy bonds from companies with lower credit ratings. Because these companies are seen as riskier, they have to pay a much higher rate of interest to attract lenders. So you get higher returns, a higher rent.
But you are sleeping on a bed of dynamite. You are fundamentally betting on the fund manager's ability to be smarter than the credit rating agencies.
To spot a risky company that won't actually default.
If the manager is a genius at spotting these turnaround stories, you can make great money. If they get it wrong, defaults happen, and you can lose capital.
Okay, that's accrual. Now for the tricky one, duration. This is the trading model.
This is the part that confuses everyone. It relies on the fundamental inverse relationship between interest rates and bond prices.
Explain that like I'm 5, please.
Okay, imagine a seesaw. On one end of the seesaw, you have interest rates in the economy. On the other end, you have the prices of existing bonds. They always move in opposite directions.
Okay.
When interest rates go down, bond prices go UP.
But why? That feels backwards.
Okay, imagine I own an old government bond that pays me 8% interest. I bought it last year. Suddenly, today, the central bank cuts interest rates, and all new bonds being issued now only pay 5%.
Right.
What happens to my old 8% bond?
Oh, it's suddenly way more valuable.
It's incredibly valuable because you can't get that 8% yield anywhere else in the market. People will pay me a premium more than I originally paid to buy it from me. The price of my old bond skyrockets.
Ah, okay. So if a fund manager thinks the central bank is going to cut interest rates soon,
They will start buying long-term bonds. We call this increasing the portfolio's duration to capture that big price jump when rates fall. They aren't just playing for the small interest payments, they're playing for a big capital gain.
but what if they're wrong? What if the central bank raises rates instead?
The seesaw crashes down on the other side. My old 8% bond looks terrible when new bonds are paying 10%. Its price plummets.
So you can actually lose capital in a debt fund.
Yes, this is duration risk. And a fund labeled as a long-duration fund is highly sensitive to these interest rate changes. It can be almost as volatile as an equity fund sometimes.
This leads directly to a huge trap that the text calls out specifically, the name conservative hybrid fund.
Oh, this is a classic nomenclature trap. It's so misleading.
You see the word conservative and you think safe. You think bank vault.
Of course you do, but it's not what it means here.
It's not.
No. In this context, conservative is a technical term defined by SEBI. It just means the fund invests mostly in debt, between 75 to 90%, and only a little bit in equity. It refers only to the asset allocation.
It says nothing about the riskiness of those assets.
Nothing whatsoever. That 90% debt portion,
Could be stuffed full of those risky junk bonds we just talked about.
or it could be full of long-duration bonds that are set to crash if interest rates rise. The label conservative does not in any way guarantee the safety of your capital. You have to look under the hood.
Always look under the hood. Speaking of which, let's talk about gold. People buy gold for safety, as a hedge. But the workbook draws a sharp distinction between a gold ETF and a gold sector fund.
They are night and day, completely different investments.
Also,
A gold ETF, an exchange-traded fund, its job is to track the price of gold. Usually does this by buying physical gold bars and storing them in a vault, or by using gold derivatives.
so if the price of gold goes up 10%, my ETF should go up by roughly 10%.
Exactly. Mine, it's a very small tracking error. It's a direct play on the commodity itself.
Then the gold sector fund.
That doesn't buy gold. That buys shares of companies that mine gold.
And why is that such a big difference?
Well, imagine a scenario where the price of gold soars. It's at an all-time high. But the biggest mining company in your fund's portfolio has a massive worker strike that shuts down production for 6 months.
The company's stock is going to tank.
Or a mine collapses. Or the CEO gets caught in an embezzlement scandal. The company's stock could get hammered even while the price of the commodity they sell is going through the roof.
So if your goal is to hedge against inflation and currency risk, you should buy the ETF.
Yes.
If you want to make a specific bet on the business of mining and you've analyzed the companies, then you buy the sector fund.
Correct. Do not confuse the metal with the miner. They're two very different bets.
Okay. We are in the home stretch now. This has been fantastic. We know what we need. We've figured out our strategy. Now we have to pick the specific fund from the thousands out there. We have to evaluate the chef. How do we do our due diligence?
The very first step, according to the workbook, is to check for true to label. You have to open the box and check if the contents actually match what's written on the label.
You were talking about style drift.
Exactly. This is a huge problem. If you decide to buy a value fund because you want exposure to undervalued companies, you need to open that fund's monthly portfolio fact sheet. If you see that its top 10 holdings are all the same expensive, high-flying tech stocks that everyone is chasing,
Then the manager is shooting on the mandate.
they're serving you steak at a vegan restaurant.
Yeah.
And that's a problem because it secretly ruins your carefully planned asset allocation.
You think you're diversified, but you're not. You might already own those same tech stocks in your growth fund. Now you're accidentally doubled up on the same risk.
You're far less diversified than you think.
Okay, so after checking it's true to label, what's next? Everyone immediately looks at returns, right? That last 1-year return number.
And that number in isolation is almost useless. It's just noise. You need context. The workbook says you have to compare the fund's returns against two specific things. Its benchmark and its peer group.
Explain the difference.
The benchmark is the market index that the fund is supposed to be competing against. So for a large cap fund, that might be the Nifty 100. If the market, the Nifty 100, went up 20% last year and your fund only went up 15%.
Your fund still made you money, but the manager failed at their job.
They failed. You paid them a higher fee for active management and they gave you underperformance. You would have been better off in a cheap index fund.
Okay, that's benchmark. And the peer group.
That's comparing apples to apples.
Yep.
You're comparing your large cap fund to all the other large cap funds out there. If the average fund in the category returned 25% and yours only did 20%, again, your manager is lagging the competition.
You want a fund that consistently beats both its benchmark and is in, say, the top quartile of its peer group.
That's the goal. And when we look at that history, the workbook makes a great point. It recommends looking at rolling returns over simple point-to-point returns.
What on earth is a rolling return?
Point-to-point is just arbitrary. It's the return from January 1st to December 31st. But what if the market had a huge crash on December 30th, or a massive rally? That one day can skew the entire year's number.
It's just a fluke of the dates you chose.
It's just luck. Rolling return smooths all of that out. Imagine taking a 3-year measurement window and sliding it, 1 month at a time, across the last 10 years of data.
Okay.
It calculates the return for every possible 3-year period in that time frame. So it can tell you something much more powerful, like in 90% of all possible 3-year periods over the last decade, this fund delivered a positive return.
Ah, so it measures consistency, not just luck. I like that a lot. What about this other metric, portfolio turnover ratio? It sounds like an HR statistic.
It kind of is. It measures how manic or hyperactive the fund manager is. A turnover ratio of 100% means that the manager effectively sold and replaced every single stock in the portfolio within 1 year.
Wow. Is high turnover automatically a bad thing?
Usually, yes, for a couple of reasons. First, every time the manager buys or sells a stock, it costs money brokerage fees, taxes, impact costs. Those costs eat directly into your returns.
It's a drag on performance.
A huge drag. And second, it often suggests the manager lacks conviction in their picks or is just chasing short-term trends.
Unless, is there a time when high turnover is okay?
The only exception is if the fund's stated strategy is high-frequency trading, like a momentum strategy fund or a quant fund, where the model is designed to trade a lot. But for a long-term value fund, high turnover is a massive red flag.
Okay, size matters too, right? AUM, assets under management. Is bigger always better?
It depends on the asset class.
Yeah.
In debt funds, generally, yes.
Yeah.
A bigger fund has economies of scale, which can lead to lower expense ratios. They also have more negotiating power with the companies they lend to.
But in equity, specifically in the small cap space.
In small caps, being too big can be a curse. It's the whale in a bathtub problem.
Too big to move without making waves.
Exactly. If you're a fund manager with, say, $2 billion that you have to invest in tiny little companies, you have a huge problem. You can't buy enough shares of any one company without dramatically driving up its price.
And you can't sell without crashing the price.
Right. You become the market. That's why the best small cap funds often close for new subscriptions when they get too big. They do it to protect the returns of their existing investors.
So for small cap funds, looking for one that is smaller or mid-size might actually be an advantage. It's more nimble.
It's much easier to maneuver a speedboat than a giant cruise ship in those narrow waters.
And finally, we have to talk about the price tag itself, the expense ratio.
This is the only guarantee in investing. Returns are always hypothetical. Fees are always real.
And they come out of your pocket every single day.
Every day. And in a low return environment like debt funds, a high expense ratio is an absolute killer. If the underlying bonds are only yielding 6% and the fund company is taking a 1.5% fee,
They just took 25% of your profit.
it's brutal. In equity, where you might be hoping for a 15% return, a 2% fee feels less painful in the moment. But over 20 or 30 years, the difference in your final corpus between a fund with a 1% fee and one with a 2% fee is massive, all because of the lost power of compounding.
Okay, last decision. You've done all the research, you're filling out the application form, and there's a checkbox. Growth or IDCW. And IDCW used to be called dividend.
Yes, and this is where the NISM workbook provides a crucial reality check for investors.
Yeah.
So many people automatically tick IDCW or dividend because they think it's a bonus. They think, oh, look, the fund sent me a check for 5,000 rupees.
Who doesn't like getting a check in the mail? It feels like extra income.
It feels like a profit. But it is not a bonus. It is not extra income. It is simply a withdrawal. It is your own money coming back to you from your investment.
Wait, walk us through the math on that.
Okay. Let's say you own 100 units of a fund, and the NAV, the price per unit, is 100 rupees. So your total investment is worth 10,000 rupees.
Simple enough.
The fund then declares a dividend, or IDCW, of 5 rupees per unit. So you get a check for 500 rupees in your bank account.
Great.
But at the very same instant that dividend is paid out, the fund's NAV drops by that exact amount. The NAV instantly goes from 100 rupees to 95 rupees.
So my remaining 100 units are now only worth 9,500 rupees. Plus the 500 in my bank. I still have 10,000. I haven't made anything.
You've just moved 500 rupees from your left pocket to your right pocket.
I just shuffled my own money around.
Exactly. And guess what? Depending on your tax bracket, you might now have to pay tax on that 500 rupees that you just received.
Oh my God. So I've actually created a tax bill for myself for no reason, just to get my own money back.
Yes. The workbook is very clear. Unless you are a retiree who specifically needs that regular cash flow to live on, you should almost always choose the growth option. Let the profits stay in the fund, get reinvested, and compound tax efficiently.
That is the single clearest explanation that I have ever heard. Thank you. We've covered a massive amount of ground here.
We have.
From defining our needs, building the core satellite architecture, climbing the risk ladder, debating active versus passive, digging into debt fund strategies, and finally, checking the expense ratio.
We've really tried to turn what feels like a chaotic mess of options into a systematic, logical filter.
And the workbook ends with a final important note on the distributor's role in all of this.
Yes. It emphasizes that if you are using a financial distributor or an advisor, their primary job isn't just to sell you a product or to pick the fund that made the most money last year.
Right.
Their legal and ethical duty is something called suitability.
Matching the right product to the right person's need.
Exactly. If a distributor tries to sell you a highly volatile small cap fund when you've told them you need the money for your daughter's wedding in 6 months, they are failing at their job.
It's like a doctor prescribing antibiotics for a broken leg.
It's the wrong tool for the job, and it's dangerous.
I want to leave our listener with one final thought that was in the outline that really struck me. It's a quote: "Diversification is a protection against ignorance."
It's a very humbling but powerful concept. Think about it. If you knew with 100% certainty that one particular stock, say Tesla, was going to go up 100% next year, would you diversify your portfolio?
No. I'd sell my house, my car, everything, and put it all on Tesla.
Of course you would. You diversify precisely because you admit that you don't know the future. You admit you are ignorant of what is going to happen. It's a risk management tool.
Right.
So the provocative thought is this. Look at your current portfolio. Is your diversification genuinely protecting you against your ignorance? Or have you bought a bunch of things you don't really understand? Complex hybrid funds, niche sector funds, credit risk funds. And are you actually increasing your exposure to risks you haven't properly researched?
Are you managing your ignorance, or are you just amplifying it by buying things you don't get? That is the question to ask before you click buy.
So I'd encourage everyone listening, pull up a fact sheet of a fund you own today. Find the risk meter, look at the portfolio turnover, see if the portfolio you have is actually the one that's built for you.
Thanks for diving so deep with us today.
My pleasure. Happy investing.